the latest push for Buy Nigeria to boost production in the country. Let's find out how this can work. You know, despite macroeconomic headwinds, we're still battling with high inflation, high interest rates in the country. We've heard organized private sector talk about how hard it is to make profit if you're taking a loan at about 37 or over 30%. Definitely a tall order there. But joining us to discuss, we have Mr. George Nofowoka, is the MD CEO, Common Wires and Cables. He's joined me right here in the studio. It's great to have you.
Morning.
Morning, sir. Yeah, so definitely, I love the sound of that, you know, Buy Nigeria. But, you know, definitely it will take a lot.
Correct. To
make that happen. And, you know, we've seen the usual issues, you know, at this time. High inflation. We see the inflation numbers for April, even though it's the rebased data, 23.71%, food inflation, 21.26%, core inflation, 23.39%, and they're much lower than what we're used to, you know, before the rebasement. Then we have the May decision, that's for the MPC, telling us how much it will cost for you to get a loan, you know, from the bank. And we see that it was retained at 27.5%. And, you know, definitely we know organized private sector is saying, you know what, we want lower rates. But the CBN is trying to battle inflation. How do you balance all of this?
Okay, first of all, on the issue of Buy Nigeria, I think that's commendable from the side of the government, especially from presidency, that we finally have an executive order, an approval from the Federal Executive Council headed by the president to actually have that in place. Good policy implementation will be key. What the Bureau of Public Procurement does and how they manage it, because from everything that I said, they are supposed to manage it for us. And how the manager for the government really will be the key. The government still happens to be the biggest infrastructural capital spender in the country. So if they spend in infrastructure, and if the capex spent on infrastructure goes in the direction of Buy Made in Nigeria, you definitely would see a rise in the competitiveness of locally made goods. Because the more volume you give them, the more adequacy they actually get into, the more competitive they get. And the good thing about it is that it's there to drive jobs. If I know fully well that the government will patronize me for either my cars, for cables made in Nigeria, or for steel, cement, definitely we know we buy made in Nigeria. Those are the things that will be the driver for the economy going forward, where you tend to see so many government-related contracts that end up with a lot of importation, which is very sad. Even simple places like TCN, if you look at it, the amount of areas that they can look inwards, which they've done in the past, but really, what is the percentage of transmission that we actually buy local? What's the percentage of distribution that we buy local? And those are the key things that let's wait and see. You know, for me, it's always good initiatives, but the good initiative, you only tell the tale of a good initiative in the implementation of the good initiative.
I'm talking about Buy Nigeria now. Are you seeing any signs that the government, on the government side, they're actually pushing towards buying Nigeria? Are there any signs?
I'm sorry, it's too early to say. Sincerely, this thing was actioned 6th of May, and we're looking at, I think the first criteria we'll see is when they start buying cars in Nigeria by the government. I think that's the first thing most agencies tend to easily grab hold of, is vehicles. Where are they gonna buy? Innocent? Are they gonna buy GAC? Or some of the other locally manufactured or assembled car companies? If they go that direction, then we'll start seeing immediate impact. Then the rest will fall in place. If we then take those type of things into what you were talking about, interest rate, inflation, and then we tail back into that, the impact element of that is, it's also positive. But where are we at inflation? Inflation at 23.71, which you said. which is easing. Let's be fair, it is actually easing. We're coming from a 24.23 down or 53 to where we are now. We're about 0.52% down, which it shows it's easing. Now, we've had two MPCs that actually have held rates, which were my position, that they would hold rates. Now you wonder why, where the drive really, and for manufacturers, we need reduced interest rate, but you have to be sometimes fair on who manages the macro side of the economy. Is trying to balance inflation, FX positions, and interest rates, which are indicators that literally those three, they need to converge for you to actually start saying it. But I knew, and for me, it was the fact that you won't see a rush to a reduction in interest rates. I think for us, looking at 2025 as an indicator for any manufacturer, it will be for the government or for those managing the monetary policy of the country and the macro side, which is the central bank and the rest of. I foresee that, and which is what I said from the beginning of the year, they'll be looking for more like stability rather than a guarantee to push towards a lower interest rate, the currency that would have appreciated. I see that for 2026. I do not see the drive yet. We need it, not to that. But the whole economy is tilting towards that. If you look at it today, if you look at the debt capital market, the commercial paper, the bonds, it's tilting down. So interest rates at the end of quarter 24 in the CP market was going as high as 31, 32 for a 270-day position. Today, we have interest rate tailing down to about 24, 25, and it's still tailing down. Now, so the reality is that most people are taking long positions on savings, but they're taking short positions on debt capital, because everybody's seeing debt capital as something that is going to tail down. Now, the real side is that we want debt position in the double digits, lower double digits, which we basically in their teens. So 15, 16, 17, 18, and we need that in the teens, not in the 20s. But it will tail down as we see inflation tailing down. Now, we will be all looking really towards the next MPC. The current one was a bit predictable. Is
the next one predictable, in your opinion?
For me, they can't hold the next one. They've held twice.
Okay.
Then you have a situation where inflation is tailing down and it's easing. There's no excuse to hold a third one. And they cannot increase, let's be frank. So holding a third one literally will be shooting all of us in the foot, because the expectation is by the time you're entering third quarter, we should start seeing an easing of interest rates. So it is the same expectation. The market is already driving it, whether the CBN likes it or not. We're already driving it. If I'm going to the market today and I'm going at the market below MPC, I'm going closer to Treasury bill rates, then it tells me that, look, the market pricing is not right, it's distorted. Same thing with, if you look at it, let's be fair, even the Naira real value today is not 1625. We all agree it should be tailing down to the lower 1500s. But I think everybody is trying to let everything lie in its way to try and manage the expectations of what each individual area of it, from inflation to interest rate, FX position, how it actually influences all our decision making.
And talking about expectations, we did see the survey from the central bank there, and talking about firms and households, the expectations of what's going to drive inflation. Energy, that was number one. With PMS, diesel, 91% of firms said that's what's going to drive inflation. Correct. 88% of households says that is their concern, for inflation. And you have exchange rates, transportation costs, interest rates came in at, I think, number 4. 84% of firms say yes, that's driving up inflation. 80.9 households. I guess households don't really care for interest rates. Then, talking about the next meeting, at this point, you said they cannot hold. Again, that's the MPC can't hold.
They can't.
So if a cut is going to come, what should be the cut? Should it be 50 basis points or 100 basis points?
It would not be aggressive. Anybody looking for an aggressive cut now basically is saying that they're still not managing the expectations. It will be a slow but steady. I don't see more than a 0.5 taking off, and then a gradual process. If it's aggressive, I think it will tail back into you. As you're trying to balance interest rate, you must also try to balance the actual demand flow of money. So you really don't want the demand flow and the liquidity to be too eased for you to and I have another run on the naira. So which basically means you are going to have an FX issue again. So in order for you to forestall that, you will ease that gradually. Now the expectation, which is the simple basic economics, is you cannot have a steady continuous rise and a quick ease. It would not happen. So the expectation would be steady ease over each MPC.
Maybe 25 basis points.
25 basis points sincerely would not be acceptable to the market, because I think we've held so long. And then you have to look at it between now and the next MPC. Most likely you're going to see further easing of inflation. Now you get another from April to May. We've got, from March to April, we had a 0.52 reduction on inflation. Most likely, if you look at what is happening today, yes, things that are driving inflation the most will be energy prices, petrol, diesel, and the rest of them, and also energy and power. Now, power has been stable. So let's hope we don't get the government talking about the subsidy removal on power from 2009. And if they remove their subsidy on the power now, you get another price increase. Then you have another inflationary push. Now, if that is not happening, and we're just looking at where we are on power, looking at where we are on prices of energy in terms of petrol and diesel.
All things being equal.
All things being equal, we have no big push for inflation at the moment, unless you can see oil push up to $80 a barrel and naira push downwards. If oil stays where it is, within the range, plus or minus $5, I think we should be seeing where we are at the moment, which will be manageable inflation rates. And then we'll be seeing turning down of those interest rates. So interest rate will definitely fall. Now, it's two ways now for anyone. To the manufacturer, where it's literally happy we're going the right direction. To anybody investing, which is what is also delaying this thing, from the FPI perspective, from the investors' perspective, where people are putting in money into Nigeria or into savings, there's the easing of your interest rate also might slow down their investment appetite for the Nigerian treasury bills or for any bond or for any debt capital market. Now, but if and only if that slowdown. But the good thing about it is that the slowdown happening and the easing of interest rates in Nigeria is the same easing happening all the rest of the world. Now, so invariably, we still keep the same margin of investment and interest. So you would not see a total exit. You will see a marginal reduction, but you still see continuous interest. Because look at it. If you come to Nigeria today, you pick up a treasury bill at around 365 days at about 24, 25, and you pick up secondary market at maybe 23. You can also pick up even lower. Now, but you're having a 20% basis. Now, anywhere in the world, there's no way you can get 20%. Even if you take the exchange rate issue, which is the exchange rate risk, which has to be factored into the risk of your investment. If I come into Nigeria today at 24%, and I take an exchange rate risk of between 150 to 165, you're talking about 3%. 3-4%. So if I take that off my basis of my 24%, even take 4%, I'm still landing at 20%. Take it off the capex, most likely it takes off about another 2% of your capex. You're taking a 6% off court. A 6% off court of your interest yield of 24% is 18. There's no place in the world any FPI can get that type of money. So Nigeria is still a sure bet for most portfolio investors in this country.
For the hot money.
It's
at this point.
It's a good place for anybody saving. I still am the keep your naira. Enjoy the interest rate while it lasts. When it starts easing, then pump it in. But at the moment, is everybody that is in the cash is in the money. Anybody that doesn't have cash might be in the negative because the borrowing cost is high. Although the borrowing cost is high, we've moved away from, let's be fair, the commercial banks did not get business at 36. They did not see business. Today, I'll say interest rate in Nigeria today has eased back to about between 30 and 32 at the top end. The lower end is really, you'll be shocked to find that the bank, as much as CBN's rate is 27.5, which is the MPC rate and the MPR rates, the reality is no bank is lending more than, at top end, they're lending between 28.5 to 30%. And so, because it wasn't realistic anymore. And the market could not be moved. It was not moving in the right direction.
That's coming from a time of about 35.
Yeah, they have come down. Let's be fair on the commercial banks. They have come down. And I think as they see the interest rate coming down, they're also being a bit more. I think the banks, let's be sincere, are actually being a bit more dynamic in how to create lending and create funding dynamics that is acceptable and competitive. We've gone away from when banking was all about sit down and just do whatever you want to do and get away with it. Your business will not thrive. And the type of indices the banks are declaring now, I think it's not as easy as before, where if you declare almost next to nothing, nobody cares. The figures on PAT and indices on ratios are now so expectantly high, they must perform. Now, the non-performing loans might be a little bit high, so they have to be very cautious. That the reality is, as I was talking to one of our banker friends, said the reality is at the end of this year, the forbearance that the central bank has given all the banks to cover some of their non-performing loans will end this year. So by the end of 2025, all of us will know really how much non-performing loans exist in this system.
Right.
And so I think now the cautious approach by most of the banks is to make sure clear up their books. But the key thing for most manufacturers, and I think the key thing is that the drive for local content would help massively if the policy to back it, fiscal policy to back it, and the political will to back it actually is seen by everybody in every ministry. It shouldn't be talk shop at FEC, and then after the talk shop, lovely news for 1 week, 2 weeks, 3 weeks like we've had. Question is implementation. And really, the success story of that will be the quick revival of the economy, will be the quick GDP upside, would also be the quick wins for the government in terms of creating employment, creating jobs, creating stability within the system. Because those are the things that drive. But if you are the biggest, if you look at the percentage of the budget that is spent on capital, and you then make even just 20, 30, 40% of that a guaranteed local content, it's trillions of naira embedded. And the more you push the levels of that capex infrastructure spend into a 50, 60%, 70%, it changes the dynamics of where and what we can do with this economy, what we can do with growth in industry and manufacturing, and how we can guarantee the jobs that are being created in the country.
I guess, at this point is, buy Nigeria yesterday, at this point, from the government side and to the people. And we're seeing what's playing out in the global space with tariffs. I know you're into the export business, so I'm sure you get nervous sometimes with some of those tariff calls. Then we also see President Trump trying to, push most of the big producers in the U.S. to come and set up shop, their production shop right there, manufacturing in the U.S. Bring all those jobs back in, not taking it to India or China.
I think it's an impossible task. Let's be fair. Look, Trumpism, or whatever we call it today, it's really is an ideology that is literally impossible to achieve. We have had over 100 years of globalization. You're trying to tear the rule books of what you've done for 100 years overnight. I think it's impossible for them to achieve because look at it. The mere fact that today, the same globalization created China as a global hub for industry. But today, China is also struggling because cost to labor is high. So what is China doing? It's actually moving out of China.
So China is moving out of China.
So the reality is, look, the cost to labor in the U.S. is not practical for some of the things they want to do. It's like saying you want to go and start making fabrics in the U.S. The cost to labor for those things that have been done in Bangladesh, in Pakistan, is literally impossible for you to achieve that cost to labor and cost efficiency of those production in the U.S. So it is not everything that you can produce in your country. We need to be factual of that. So for me, it's
an ideology.
It's a fantastic ideology. It looks good.
But
everybody will come back to the playing field later on, and this thing will die a natural death.
Fantastic. It's always great having this conversation.
Thank you.
With you. That's Mr. George Onofo Walker, the MD CEO, Coleman Wires and Cables. Thank you for coming on
Thank
today.
you, Laddie.